Hey, what's up? Welcome back to the Chambers channel. Stop what you're doing. This is what you should be doing. Subscribe, subscribe, subscribe. 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 I felt really empowered talking about mutual funds and index funds because it takes away from the uncertainty that investors have when they're picking out stocks or trying to invest. Because relying on yourself sometimes could be a strain. You want to be able to have a manager there who might be an expert in their field to pick some stocks out for you, and I think that's better overall when you're in reference to investing. It felt amazing talking about mutual funds and index funds. It was something I felt like my community really needed, and me being able to talk about it was empowering for me and empowers the community overall. Now let's take a moment to talk about something that's very important that most people don't consider when they're investing: taxes. In my other video, I broke down the 401k and the IRA and how they're taxed different. And now I want to talk about your individual investment account and how that could be taxed and how that can have an impact on your investment strategy. Your retirement accounts, your 401ks or your IRAs, follow the same tax percentages laid out by the income tax law. But for your investment account, they're governed by what is known as the capital gains tax. A capital gain occurs when you sell an asset for more than what you paid for it. Let's break down what that means. First, it means your investment has gained in value. Congratulations! But second, it doesn't actually mean that you have the money unless you sell the asset. This second point is very important because capital gains tax doesn't actually kick in until you sell the asset. The value of the asset before you sell it is considered to be an unrealized asset. This means that it can't be taxed as its value is only conceptual. When you sell the asset for actual money, it becomes a realized asset. That's when it can be taxed. Realized assets might include stocks, bonds, jewelry, or even your home. Some assets are not subject to capital gains tax at all. This might include business inventory or depreciation. It might also include intellectual property that you create or patents you've invented. I'll talk about these more in depth in another video. Now, the key principle of capital gains tax is how long you've owned the asset. This will determine whether you pay the short-term or the long-term capital gains tax. Short-term capital gains tax happens when you buy an asset and you sell it within less than a year. It's treated the same as your personal income tax. So depending on your income, you could be taxed anywhere from 10% to 37%. This means that the more you make, you might want to stay away from short-term investing. And even if you still don't make that much money now, still pay attention. This is because if your investment pays off in the future, you still may have to pay higher taxes. The tax code really favors the long-term investor, however. The long-term capital gains tax applies to any asset you own for longer than a year. And that's not really that long at all. If you make less than $40,000 a year, you pay no taxes at all. Between $40,000 and $430,000, you pay only roughly 15%. And any income over that, and you'll still only pay 20%. It's very clear that the government wants to see long-term investing and rewards it via the tax code. There are a lot of nuances to how all this works if you own investment properties, but I'll cover that in another video. Also, keep in mind that you can use money from a losing investment to offset the taxes from a winning one. Also, make sure you consult with your tax professional before you start trying all these advanced tax strategies.